Welcome back. You're watching Stock Watch this week. Joining me to unpack your stock-related questions this afternoon is Kriegler from Kruger International. Be sure to send us your questions via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag StockWatch. Mia, a pleasure. Good afternoon. Hi, Mia. I think your mic is still muted.
Nice to be with you. Apologies for that.
Not a worry. Thank you for being with us today, Mia. Quite a bit to get through this afternoon. I want to get right into it. First question today, what was behind Nvidia's recent share price run?
Yes, so I mean, we've seen quite a lot of talk about Nvidia lately, and especially the share price run. The company is up over 140% year to date. So that's a substantial move. Also, the concentration risk in the indices, especially the S&P 500, for instance, has grown significantly, with Microsoft, Apple, and Nvidia now making up over 20% of that index. Nvidia, of course, playing a large part. Also, we heard yesterday and the day before that they'd now surpassed the $3 billion valuation mark on a market cap basis. So now the second largest company in the world. And that's a big feat. The big talk still remains the fact that we're seeing such a strong drive towards AI. And the move to AI requires a lot of chips and smart chips. And we know that Nvidia is one of the main players in the market with the smartest and most capable chips. And they supply those to all companies that take part in this AI battle worldwide to make us all go forward in terms of technology. Just an interesting thing on Nvidia while we're talking about it is we're seeing a stock split when the market closes today. So just after market close in the US this evening, we'll have a 10-to-1 stock split. So don't get a fright on Monday when you see the share price of Nvidia has fallen by 90%. It's only due to the fact that there's been a stock split, and your equity value will still be intact when you take your complete number of Nvidia shares into account.
Actually, another question here following suit from the Nvidia question, I think segueing perfectly, is looking at suppliers of Nvidia. Is it worth it at this point to look at investing in suppliers of Nvidia? I think what comes to mind for me, Mia, is the likes of the Taiwan Semiconductor Manufacturing Company, TSMC. Looking at those, considering that Nvidia could be expensive for many people.
Yes, it is, but the thing is that most people don't even realize through some or other indexation where they've got some exposure, they probably have exposure to Nvidia as well. But as you say, it's always a good idea to broaden your horizon and to broaden your diversification. And if you have your diversification in such a way that you are exposed to more than just Nvidia, for instance, on the AI side, but sort of rather to some of the suppliers, some of the users of AI technology, some of the developers of AI technology, then you'll be much better placed than to just back a one-horse jockey. It's always very dangerous, especially with a share that moves in such large bouts as we've seen with Nvidia, to place all your chips on just that one jockey.
Wonderful. Let's move on now. We'll look at Spar. Sneakily yesterday, actually, I think Spar released an update. But the viewer here is asking, what is your sentiment on Spar and its reputation? That's an interesting one, isn't it?
Yes, well, we would have actually expected Spar to have done quite a bit better than they have, given that Pick n Pay has taken the front seat as the retailer in trouble in South Africa, and that there was quite some market share to be picked up. But unfortunately, Spar hasn't really done that. They've also indicated that they've had a tough time over the past year. Their earnings per share has dipped between 13% and 3%, and that's even when we exclude the Poland business, which they are writing off. They haven't done well. One of the few companies of South Africa that haven't done well in Eastern Europe, but they're writing that business off, and it's not forming any further part of the results. If you include that, the results actually look better. So that's then down by I think less than about 12 to -2%. But nevertheless, they've had a tough time. They've had some distribution problems at their DC in KwaZulu-Natal. They didn't have a very good integration of the SAP systems that they use for their distribution. So there are a couple of problems that they've been facing, and as we can see on the market, it hasn't been going to plan for them as well.
From an investor perspective, Amir, how much can you take regarding possible challenges around IT challenges? We've seen Spar
Yeah.
consistently speaking about their IT systems and that SAP issue. It's coming up again. It does seem to be something that is more pervasive and possibly more challenging than what we initially thought.
Yes, I think this is a topic in general that has become so important, not only for a company like Spar, but as you say, rightly so, they've had many challenges around that. Even globally, I mean, we're so dependent on tech, and all of our businesses, every one of us in whatever industry or mode of business we are so dependent on technology. And if anything goes wrong or not according to plan, then it makes a big sort of challenge for all of us to proceed with business as planned. Just to bring an interesting fact into the discussion, we had a situation in the past week where Berkshire Hathaway and some of the other large companies in the US traded at very large discounted prices all of a sudden due to a tech glitch on the stock exchange there. So and they had to rectify that. So even the largest corporations in the world struggle with tech sometimes. And this is a great example that we've seen now, as you say, at Spar. One of the other companies that we've had in the news quite often lately, which has also been plagued by a lot of costing around their technology development and write-downs, is of course MultiChoice. And what we've seen there, and that they have that write-down of over $1 billion on that tech development. So yes, it's not an easy space to progress in, and if you're a smaller player, it costs a lot of money.
Let's stick with tech because AOH is next on the cards here. You were asking, are we missing something with AOH? About 55 million shares have been traded as of June 2024 to date, or possibly a different time
Yes.
to date. Yeah.
Yeah, and again, a company with really a lot of challenges of late. The share price, because of the share price falling so much, it has become one of the smaller players on our market. So that also always leads to more volatility in a share price that we normally see. But again, a lot of challenges there. The fact that the share price has had such a tough time from a sentiment level has really not helped any of the good news coming to the market. So it's really discounted that good news to a great extent. And unfortunately for the company, their troubled times haven't passed yet. So a difficult one to look at. As soon as we start playing in the small cap sector in South Africa, it's a tough environment to ensure that you're going to see substantial share price growth that follows any sort of earnings movement, because it's traded so substantially by speculators.
Another company that does seem to be in a little bit of hot water at this point, Mia, and I want to get your thoughts on it, considering that a recapitalization is on the cards here, is Brait. And of
Yes.
course, this is a company that within it, in my mind, the assets aren't even that great. I mean, Virgin Active just not, shining the way that it should. But let's talk about just your perspective here with this one.
Yeah, again, the company, the assets in the company has slimmed down quite substantially. They've sold a lot of the assets to shore up their balance sheet. The share price is down 95% over the last 5 years. It's not been a value accretion story for investors. So yes, until they have more sort of substantial investments than they currently have in the portfolio, if we don't see some good sort of drive in terms of where they're heading, what investments they want to make, how they're going to utilize sort of that strategy in terms of a balance sheet going forward, it's a tough one for me to get excited about just yet. So.
We also know that, a lot of holdcos, when they get into a tricky point, they decide to list their darling. Is Virgin Active a listing case?
Well, that's one of the assets that hasn't it's worked, but it has also been challenging. I mean, we all know how the big challenges that they sat with coming out of COVID. So I'm not quite sure that would be such a value accretion for shareholders if they do decide to list that by itself.
And then I'm also keen to get your thoughts, Mia, on what we might be seeing here with the Forshini Group. I think that's stock rallying here. We've got a question here. Do you think TFG is still a buy at these levels? And how much of a threat are the likes of Temu and Shein to local retailers?
That is most definitely a big challenge for all our local retailers. We've seen a massive influx of people ordering on these online importers. And the fact remains, we saw this strong sell-off a week or two ago, or in the past week and a half, really, after we heard the trading update from Woolworths. And it's a tough environment in South Africa to operate in. We are not seeing job growth. We are not seeing the the uh, the consumers' expendable income growing. Interest rates are still high, so that the consumers remains under an enormous pressure in terms of spendable money. And as long as that is the case, these retailers of ours will be sort of in a challenging position. They'll have a challenging environment, and it will be tough to see where their growth comes from. Of course, the move to online with Bash and how they've positioned themselves with the e-commerce business is really a positive. It's reported a turnaround growth of 44% in terms of that. So and it's actually added, I think, over 4%, contributed over 4% to their revenue, which is good. So these companies aren't, they're well managed in most cases, and especially in a TFG, it's a company that's well managed. They do what they can in a tough environment, but unfortunately, the environment is so tough that I can't get super excited about these retailers.
What's also interesting about maybe the clothing retailers as well at this point, Mia, is Pick n Pay out with their numbers. Their clothing brand was actually one of their, green shoots within the business there. And I'm wondering, what that means for traditional retailers there. And maybe even within Pick n Pay as a retailer itself, could that clothing business become the next darling? Because, of course, Boxer is on its way out in one way.
Yes, I think it'll be challenging for them to make that their next darling. I mean, we already have quite a saturated market, and like I said, we've got these influx or this influx of online retailers from the east that are dirt cheap, and that people are very attracted to due to the fact that it's so easy to make use of their online offering. The fact is that any sort of smaller, newer venture that you enter into, as Pick n Pay has now done with the clothing, has proved well. They're well positioned. They're in many of the regional malls, and they are also available in many of the larger Pick n Pay stores. So it has really helped them to just shore up that part of the business. It's a very compelling, how should I say, cost-effective offering on the market, and that's why it's done so well. So we've seen all the movement towards the cost-effective side of the market doing better than on the higher end.
And then, Amir, I think just to wrap today up, Sibanye out today, letting investors know that their lenders have relaxed some of the borrowing terms there. The share price is still down. In fact, I look at the year, it's down just under 40%. It is a PGM story, but I'm just worried about Sibanye's mix within the business there, and if they can possibly turn around when there is a recovery. Platinum prices or platinum group metals may not be a big part of that recovery story.
Yes, once again, this has been a terrible sentiment story around Sibanye that we've seen. We've seen them struggle in a time where many of the other producers of these platinum group metals have done particularly well. So again, their long-term strategy, the move that they've gone into for diversifying their portfolio, will surely pay some dividends over the longer term. But over the short term, the sentiment is just against them, and it has actually not really helped them. Some good moves, as you say, they've renegotiated with their lenders. So we'll just have to watch the space and see how the market takes it. Unfortunately, in our market, some of these companies are traded against by such large positions by speculators that it really hurts them. It's hard to really judge the share price for anything that constructively is planned for future or any long-term prospects to see that over the short term in the share price.
And the last one for today, a PPE versus JSE. What's your better pick?
Well, well, I think, we know that we've known the JSE to always be sort of a steady contender. We know where they get their earnings from, but with all the various new entrants in the market, it has been more tough for them. Still, it's a company that has sort of managed to pay and make sense to investors, because the fact that they are able to generate an income from all the listed instruments in the country is very beneficial. Yeah, so PPE, I can't really tell you which one I prefer. Neither of these are ones we're invested in at the moment. That's probably where I'll conclude on this.
All right, Mia, that's all we have time for today. I'd like to thank you for joining us on
Thanks.
Stock Watch this week today. Thank you. That was Kruger International's Mia Kriegler.